Everyone's shouting about a housing crash, but look closer. The UK market isn't one story, it's 10. Supply is scarce, demand is sticky, and cash buyers quietly set floors while headlines sell panic. Mortgages reset, yet millions are still fixed. Landlords drive record rents, and a weak pound invites global money. Planning rules throttle new builds, keeping inventory thin. This isn't 2008, it's a slow repricing where inflation erodes debt, not value. If you're waiting for a 40% collapse, you might miss the turn. Here's the uncomfortable truth: why prices may bend, stagnate, or split, but won't simply break anytime soon, though. Number 1. The myth of the housing crash. Every few months, new headlines scream that the UK housing market is on the verge of collapse, yet the numbers tell a different story. House prices have cooled, but they haven't plunged the way experts predicted. The reality is that the market is fragmented, not falling apart. Some regions, like London and the Southeast, are seeing mild dips, while areas in the Midlands and North continue to grow. The data reveals a market in transition, not destruction, one shaped by supply shortages, wage adjustments, and new lending conditions rather than panic or fear. The UK's biggest problem isn't falling demand, it's too little supply. For decades, construction has lagged behind population growth. Fewer homes are being built than people need, and that imbalance keeps prices afloat. Even when demand weakens temporarily, limited availability creates a natural price cushion. This is why, despite rising interest rates, the average price drop remains in single digits. Homeowners aren't flooding the market, they're holding tight, creating a kind of soft landing rather than a hard crash. Media outlets fuel the drama by focusing on worst-case scenarios, but the truth lies beneath the noise. A small dip in national averages hides regional strength and market segmentation. Buyers are becoming more selective, lenders more cautious, and investors more strategic. These shifts reflect a rebalancing phase, not a meltdown. The so-called housing crash is more a correction in perception than in price, a moment where the hype collides with reality and stability quietly takes the stage. The fear sells headlines, but the fundamentals, scarcity, demand, and value still rule Britain's property game. Number 2. Supply crisis, the real problem. The foundation of the UK's housing struggle isn't collapsing demand, it's chronic undersupply. For years, the government has promised to build 300,000 homes annually, but the country consistently falls short, averaging barely 200,000. This persistent gap means there simply aren't enough roofs for the growing population. Even when economic uncertainty slows buyers, the sheer shortage of housing prevents prices from sinking. Every potential downturn hits the same wall: too few homes, too many buyers, creating a market that bends under pressure but rarely breaks entirely. Local planning rules make this worse. Councils across the UK often delay or reject development proposals because of zoning limits, environmental objections, and local resistance. Small developers struggle to access land, while large firms focus on luxury projects that yield higher profits instead of affordable homes. This deeply imbalanced market doesn't just raise prices, it shapes where people live, how they commute, and which regions thrive or stagnate. Every piece of data points to the same conclusion: the UK's housing issue is a supply bottleneck, not a bubble waiting to burst. When homes are this scarce, even modest demand keeps valuations firm. Until planning reforms and large-scale construction address the real shortage, prices won't truly tumble. Instead, we'll keep seeing the same pattern: regional plateaus, minor dips, and quick rebounds. The housing crisis isn't about collapse, it's about chronic scarcity built into the system. A scarcity that quietly props up Britain's property values year after year. Number 3. Mortgage rate shock. When the Bank of England began hiking interest rates, many predicted a mortgage meltdown. Payments soared, affordability tightened, and forecasts of a housing crash filled every headline. Yet months later, the collapse never came. Why? Because nearly 4 million homeowners locked in fixed-rate deals before rates spiked. These long-term contracts insulated them from the worst of the increases, creating a lag between rising costs and real financial stress. The result is a market that absorbed the hit more slowly and more safely than analysts expected. This buffer effect has reshaped how the housing market reacts to volatility. While first-time buyers face tougher affordability tests, existing homeowners have stayed largely protected. Many are simply waiting for their fixed terms to end before making big decisions. That patience has kept forced sales and repossession rates remarkably low. Without a surge of distressed listings, the market lacks the heavy supply pressure that usually triggers steep price drops. Instead, it's witnessing selective movement, cautious buyers, strategic sellers, and slower but steady activity. Now, as inflation eases and mortgage rates begin to stabilize, affordability is gradually improving. Lenders are competing again, cutting rates to attract new borrowers, while buyers regain confidence. Analysts who once forecast a 20% decline are revising their predictions downward. What we're seeing isn't a crash, it's an adjustment phase shaped by resilience, not panic. The so-called mortgage shock didn't destroy the market, it simply recalibrated it. Britain's homeowners have weathered storms before, and this time they've learned to fix their sails long before the wind changed direction. Number 4. Foreign investors are returning. While local buyers hesitate, international investors are quietly moving back into the UK housing market. For many overseas buyers, British property still represents stability and prestige, especially in uncertain global times. The recent weakening of the pound has made UK real estate up to 20% cheaper for foreign currencies, creating a wave of opportunity for buyers from Asia, the Middle East, and Europe. London, Manchester, and Birmingham have become hotspots again, where high demand from global investors offsets domestic cooling. These investors aren't just chasing short-term profit, they see property as a long-term asset tied to political stability, a strong legal system, and rental income potential. Many are drawn by the UK's education sector and urban regeneration projects, buying homes near universities, transport links, and new business hubs. This international interest acts as an invisible floor under the market, ensuring that even when UK consumers slow down, foreign capital keeps liquidity flowing. Their activity prevents large-scale price drops by keeping the demand cycle alive. As long as the pound remains weak and Britain's property laws remain investor-friendly, overseas buyers will keep seeing the UK as a bargain in global terms, reinforcing the idea that a full-blown housing crash remains more myth than reality. Number 5. Rental market explosion. As buying becomes harder, the UK rental market has entered a new era, one defined by record demand and surging prices. With high mortgage rates locking many potential buyers out of ownership, renting has become the only option for millions. This shift has created a powerful imbalance where available rental listings have dropped sharply, while tenant applications have more than doubled in many regions. Cities like London, Bristol, and Edinburgh are seeing bidding wars for apartments, pushing average rents to their highest levels in history and reshaping the entire housing dynamic. Landlords, once squeezed by new taxes and regulations, are now regaining leverage. The combination of limited housing stock and rising demand means they can charge more while facing minimal vacancy risk. Many property investors who considered selling are instead choosing to relist as rentals, seeing stronger and more stable returns than through resale. For them, property isn't just shelter, it's an income-producing asset in a tight market. The rise in rental yields is quietly reviving investor interest, even as traditional buyers retreat. This rental surge has deep ripple effects. Young families delay ownership, professionals relocate more frequently, and city economies evolve around flexible living. But the biggest takeaway is this: soaring rents prevent housing prices from collapsing. As long as rental income remains high, property remains valuable. Investors see rent as proof of demand, and that keeps money in the market. The so-called housing crash loses power when people are still desperate to rent and willing to pay more every month just to stay in place. Number 6. The wealth gap effect. Behind every housing statistic lies a silent force, the growing wealth gap. As interest rates climbed and affordability weakened, one group stayed untouched: cash buyers. These are retirees, investors, and international clients who don't rely on mortgages. In 2025, cash purchases account for nearly 4 out of every 5 transactions, the highest share in over a decade. This group sets a solid floor under the market, ensuring that prices don't spiral downward even when borrowing costs rise. Their financial strength cushions volatility and keeps the upper and middle segments of the market surprisingly stable. For wealthier households, real estate remains a store of value, a hedge against inflation, and a tangible legacy asset. They're not buying out of necessity, but strategy. With savings and investment portfolios inflated during years of low interest rates, many are reallocating that capital into property, viewing it as safer than equities. This inflow of cash-driven demand creates resilience in prime regions such as Surrey, London, and the Cotswolds, areas that rarely follow national trends. Their stability, in turn, influences how national averages appear in market data, often hiding regional pain behind overall steadiness. Meanwhile, first-time buyers continue to face record barriers. Deposits are higher, lending criteria stricter, and salaries have failed to keep pace with housing inflation. Yet, even as affordability erodes for the working class, the cash-rich minority keeps transacting, preventing widespread devaluation. It's a two-speed market, one slowing, one thriving, but both moving in the same direction: preservation, not collapse. Until that gap narrows, the UK property market will continue to reflect not just supply and demand, but the deep divide between those with liquidity and those without it. Number 7. Government intervention. Whenever the UK housing market shows signs of strain, the government steps in, not out of generosity but out of necessity. A full-scale housing collapse would ripple through banks, construction, and consumer confidence. That's why policymakers have repeatedly introduced stabilising measures such as Help to Buy, shared ownership, and first home schemes. These programs create artificial demand, helping new buyers enter the market when affordability dips. Even when critics call them stopgaps, their effect is clear: they prop up demand and keep transactions flowing. Politically, no government can afford a crash before an election, so support is almost guaranteed. Beyond direct subsidies, fiscal incentives also shape the market. Stamp duty holidays, mortgage guarantee schemes, and green home grants have all been used to stimulate housing activity during downturns. Every time the market cools, temporary reliefs reignite momentum. The state's deep involvement means property values are not left to pure market forces. Real estate remains too big to fail. It's intertwined with employment, taxation, and national wealth. This built-in protection keeps prices from falling too far for too long. Even at the local level, councils and city mayors implement affordable housing quotas and urban regeneration funds to keep development alive. These measures don't always fix affordability, but they maintain liquidity. Every intervention, no matter how small, signals that the UK housing market is being actively managed, not abandoned. This constant political and financial lifeline ensures that while the market may slow, it rarely stalls completely. Government action turns potential free fall into controlled descent, preserving stability in one of Britain's most vital and visible economic pillars. Number 8. Inflation's hidden role. Inflation is often blamed for squeezing households, but in property it plays a different game, one that protects asset holders. When the cost of living rises, the value of money falls, but tangible assets like homes rise in nominal value. This simple truth has kept real estate attractive even during economic turbulence. For many, property isn't just shelter, it's a hedge against inflation, a safe place to park wealth while currencies lose purchasing power. That's why investors and homeowners alike cling to their properties rather than sell in fear. They know that over time, inflation quietly erodes debt and boosts equity. Consider this: if inflation averages 5% a year while your mortgage rate is 3%, the real value of that debt is shrinking. Homeowners effectively repay less in real terms every year, even if the number on paper stays the same. This dynamic favors long-term holders and punishes those waiting on the sidelines for a mythical crash. It explains why selling pressure remains low. People prefer to wait out high rates, knowing inflation works silently in their favor. For the wider market, inflation reshapes behavior. Investors seek assets that keep pace with price growth, renters push for higher wages, and landlords raise rents to match costs. The entire cycle feeds back into sustained property valuations. Rather than deflating the market, inflation solidifies it. It redistributes wealth toward those who own rather than those who rent, reinforcing the divide between asset holders and wage earners. The irony is striking. The same inflation that makes life harder for millions is also the invisible force keeping the UK's housing market upright. Number 9. Media fear versus market fundamentals. Turn on the news and it sounds like Britain's housing market is seconds away from collapse. Bold headlines warn of plummeting prices and financial chaos, but when you look past the noise, the data tells a calmer story. Most regions have seen modest corrections of 5 to 8%, hardly the crash many predicted. Employment remains strong, repossessions are near historic lows, and the number of unsold homes is still limited. These are not the markers of a market in free fall, they're signs of a system absorbing pressure while maintaining balance. The problem lies in narrative distortion. Media outlets thrive on panic because fear drives clicks, views, and shares. A headline saying house prices hold steady won't trend, but housing market implodes will. That distortion shapes perception more than reality. Buyers hesitate, sellers panic, and the conversation becomes self-reinforcing. Yet underneath the hype, core fundamentals, limited supply, strong rental demand, and cautious lending standards remain the same. These elements act as anchors, holding the market steady even when sentiment wavers. Historically, housing downturns in the UK have been short-lived and regionally uneven. What's happening now fits that pattern exactly. Some areas dip slightly, others recover quickly, but the system never collapses outright. It's a cycle of adjustment, not destruction. When the headlines fade and numbers settle, the so-called crash will look more like a pause for recalibration. The difference between fear and fact is vast, and while the media fuels emotion, the fundamentals continue to dictate the truth. The UK housing market isn't broken, it's simply adapting to a new normal. Number 10. The real future: adjustment, not collapse. The next chapter for the UK housing market won't be defined by destruction, but by adaptation. Prices are unlikely to surge the way they did during the pandemic boom, but neither will they nosedive into chaos. What's emerging instead is a slow correction, a recalibration where property values align more closely with earnings, interest rates, and regional demand. It's a period of cooling, not collapse, where the market finds a sustainable rhythm after years of distortion. Homeowners are holding firm, buyers are negotiating smarter, and lenders are cautiously loosening terms. This quiet balance signals stability rather than crisis. By late 2025, analysts expect growth to return modestly, driven by rate stabilization, gradual wage recovery, and consistent rental demand. The country's chronic housing shortage will keep a natural floor under prices while inflation continues to erode debt and protect long-term holders. The so-called bubble many predicted has turned out to be a pressure valve, releasing steam but not bursting. Instead of panic, what's taking shape is resilience, a market learning to operate in higher rate territory without collapsing under its own weight. The real truth is simple. The UK housing market is evolving, not imploding. It's becoming smarter, more regional, and more realistic. The coming years will favor informed buyers and patient investors, those who see beyond fear-driven headlines and focus on fundamentals. What lies ahead isn't the end of Britain's property story, it's the beginning of a new, balanced chapter where stability replaces speculation and the myth of the inevitable crash finally fades into history. The UK housing market isn't collapsing, it's transforming. What looks like chaos in the headlines is really a long overdue correction, shaped by higher interest rates, tighter lending, and smarter buyers. Beneath the fear, the core forces, limited supply, foreign investment, strong rental demand, and government support remain firmly in place. Prices may wobble, but the foundation isn't crumbling. Britain's property market has weathered inflation, recessions, and political turmoil before, and each time it's adapted rather than fallen apart. The story isn't about a crash, it's about rebalancing and resilience in a system too vital to fail. If you're waiting for the big drop, you may be waiting forever. The real opportunity lies in understanding the shift, not fearing it. Whether you're a buyer, investor, or simply watching from the sidelines, the coming years will reward knowledge, timing, and perspective. If you found this breakdown valuable, like this video, subscribe to the channel, and share your thoughts below. Where do you think UK house prices are heading next? For more deep dives into Britain's economy, housing trends, and market psychology, watch our next video and stay ahead of the headlines.